Is there one that doesn't have this thing? Okay, so this is the IBM. These are their financial statements. So the idea is every company that's publicly traded has to send out financial statements. They're required by law. They actually have to send out 4 of them a year. They have 3 quarterly ones and then an annual set of financial statements. So they send those out every year. And the question is, and if we look at this, is how do you know that you can rely on these financial statements? They're made by the company after all. IBM makes IBM's financial statements. So, when IBM makes these financial statements, the question becomes, here's the income statement. Their income is, these are in millions, so their income was 5.5 billion. How do you know that that is a good number? How do you know that you can rely on that? And, this is their balance sheet. Balance sheet's continued on the next page. Statement of cash flows. So this is how much, how do you know that they had inflows of cash of $18 billion? How do you know? How do you know if that's accurate or not, or at least accurate enough that you can make a decision based on it? Well, here's what happens. This comes into play. A little bit bigger. This is what CPA firms do. They do audits of companies. And they do audits of companies, and then they issue reports on those. It is what your CPA license allows you to do that other people can't. For example, I can't practice medicine. I don't have a medical license. Okay. So the CPA license, what does it allow you to do? It allows you to do audits. No one else can do them. It's something that only licensed CPAs can do. And this is what, when you pass the CPA exam, this is what that license will say. Kind of like a driver's license says you can drive a car. A CPA license says that you can do audits. And so that's really, it's actually a fairly narrow field, but that's actually what the CPA license allows you to do. Now, if you don't do audits, you can still get the CPA designation, and a lot of people do. Like myself, I don't do audits. I used to, but I don't do audits anymore. So, I still have this license though that, but that really is what a license is. It's for doing audits. Okay. So let's go back to this. So what they'll do is they'll attach this audit report to the financial statements. And the audit report will tell whether these financial statements can be relied upon or not. Okay, now, this audit report is not meant for management. It's for people outside of the company. So if you notice who this is sent to, it's sent to people who are not inside the company. And you say, why? Why don't they send this audit report to the management of IBM? Because they're the ones that made the financial statements. They don't need the audit report. They created the financial statements. So the people who want to know if they can rely on these are the people outside of IBM. So this audit report goes along with the financial statements. Whenever they show these financial statements, by the way, this audit report has to go with it. And this audit report will say whether you can rely on these financial statements or not. That's the whole reason for CPA firms. Okay, and you'll notice that there's a number of different paragraphs here that we'll probably talk about later. But it just tells what we did. We audited the balance sheet, blah, 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 statement of equity, cash flows. We audited these basically. Now, coming down here, this is extremely important. We give an opinion on the financial statements. Now, notice that wording, opinion. It's not a statement of fact. It's our opinion on whether the financial statements are fairly represented by whatever they're showing. So opinion is not a statement of fact. It's our opinion. Now, in my opinion, blue is the best color, but it's a little bit more of an informed opinion than that. But it is still an opinion. And when you say opinion, you're also bringing in the idea of judgment. And all auditing is judgment. And that's why it's difficult. It's difficult to teach and to learn judgment. So all auditing is judgment. Now we're going to do some sampling later on. And sometimes you say, well, I can sample to the 99% level or the 95% level, right? And you can. But what level you chose to go to, that's all based on judgment. Are you going to audit to the 90% level, the 95% level, the 99, whatever level you choose to audit to, that's a judgment. So all of auditing is judgment. And you know that because it says it's an opinion. It's not a statement of fact. Okay. So in our opinion, the financial statements we do well present fairly in all material respects. So when we do auditing, we only look for things that are material, things that will make a difference. So for instance, if the coffee fund is off by $10, does that matter to us? No, it doesn't. It's not material. So another thing about auditing is that we do not look at everything, and we only look for those things that would make a difference to somebody. Nobody cares about the coffee fund at IBM. Those things are not material. We ignore them. Okay. And the two other big things that I'm going to talk about here are these two items. If I talk about material misstatement, we're looking for things that are material. We talk about material specs up here, so material misstatements. But we also talk about reasonable assurance. So reasonable assurance is that we do not give absolute assurance. We don't look at everything. We give reasonable assurance. We look at things on a test basis. We do not look at everything. Why? Well, a couple reasons why. First of all, most of the time you don't need to. You can, if they have 10,000 accounts receivable, a lot of times if you can take a sample of 1,000 of them, you can get very accurately, statistically, know exactly what amount that account is. It's a 99% level by taking much fewer than the entire sample. There's also some things that'd be impossible to do. For instance, if you wanted to take inventory of Walmart at the year end, it would be physically impossible to do it. There's not enough auditors in the world to go into all the Walmart stores, all their warehouses, all the trucks that are on the road, all the trains, all the planes that are flying goods. It's impossible to go to all those things and to have people look. So there are some things that are just physically impossible. You could not actually look at all of them, even if you wanted to. So for that reason, we don't look at everything. And we can usually get fairly accurate, though, by doing sampling. Okay, so going on here to the end, and this is what you pass the CPA exam to do, to sign off on audit reports. Only CPAs can do this, and this is the PricewaterhouseCoopers CPA firm, and they have the ability, because whoever did this audit is licensed, they're all licensed, and so they can sign off on this audit report. And again, this goes along with the financial statements themselves so that people can believe the financial statements. Now, notice we never come out and say the financial statements are accurate. We never say that, these numbers are exactly accurate. We never say that. We say that there's reasonable assurance, not absolute assurance, but reasonable assurance about whether they are free of material misstatement. So we give reasonable assurance, and we only say that it is for material misstatements. They may very well be misstated, but not by a material amount. So it's a little bit different than most people think. Another thing too is these financial statements are not the audit report is only for the financial statements. It does not say if this company is a good investment. This if you read through that audit report, at no place in this audit report does it say that IBM is a good investment. It simply goes through, this was a little bit longer report than what you'll see from most places. But the audit report itself is not a stamp of approval. It's only saying you can rely on these financial statements. Is it a good company to invest in? Well, you get the financial statements to look at. You can rely on these, and you can make your own decision whether they're a good company to invest in or not. But they do not make any kind of a judgment as far as whether the company's a good investment or not. That's something again that the public sometimes doesn't get. Sometimes people in the public say, this company went bankrupt just 5 months after getting a clean audit report. The question becomes, can a company that's performing badly, let's say losing money, can they still put out accurate financial statements? What do you think?
Yes.
Yeah.
They can accurately reflect that they're not in a good state.
Yeah, they're going to look bad, but yeah, they can put, just because the company's going bankrupt or, they're losing money doesn't mean they can't put out accurate financial statements. And that's the only thing that we do as auditors is look at these financial statements and say whether they are, free of material misstatement. So, it is not a stamp of approval. And so when people say, this company went bankrupt just, after the auditors gave a clean audit report, it has nothing to do with that. It's simply saying the financial statements were not materially misstated. So anyway, that's kind of a gap that's between the expectation of the public sometimes and what we are doing. Okay. Tell you what, let's go ahead and, at 6:51, how do we do this? Let's go ahead and take a break. How about we'll take a break and come back at I almost ended our thing here. Let's go ahead and take a break. We'll come back at let's come back at 7, say, and then we'll start in. We'll maybe do a little bit on the chapter 1 and 2 handout, and I'd like to do a little bit on the sampling one too, just to kind of get a get us going in the right direction. So let's come back at say 7. We pull up the chapter 1 and 2 handout here. Say back at okay, so let's go ahead and take a break, and we'll come back and we'll do a little bit through this one, the chapter 1 and 2. And you can't see my screen. There we go. Okay, so we'll start going into chapter, the chapter 1 and 2 handout that hopefully you have. Look back up here. I'm gonna page through this for a second. Okay. All right, so this first thing, we already kind of talked about this as the IBM example. And so the demand for audits is basically that oops. Hey. So why do we have audits? Because to provide reasonable assurance of whether the financial statements wait, I have the wrong mother here. Oopsie-daisy. Okay, so why do we have audits? To provide reasonable assurance, but where the financial statements are free of material misstatements. So people can rely on the financial statements. And notice if they couldn't rely on them, what that would do for the economy. No one would invest in companies. They couldn't rely on the financial statements. So there is a real need to have somebody else come in and take a look at it. Okay, so what do independent auditors provide to the financial statements? Which one of those most likely is?
Credibility.
Yep. Yeah, they give credibility to the financial statements, and that really is what we, the only thing we really provide is that we don't say they're accurate. We don't say that we have more knowledge. People at IBM are more knowledgeable about IBM than we are, and we never give absolute assurance. But we give credibility to the financial statement. People can rely on it. Okay. Business risk and information risk. We talked a little bit about this. Business risk is the risk that a business will go bankrupt. Hold this. In the business, and when I say client, I mean as auditing, we're talking about the client, the financial statements we're looking at. And so if you're in business, there's the possibility you could go bankrupt. Information risk is a risk that an undetected material misstatement will appear financial statements. So information is a risk that an undetected material misstatement will appear in the financial statement. So when business risk, will they go bankrupt? And information risk is the risk of an undetected material misstatement. As auditors, which one are we more concerned with?
Information.
Oh. Yep. Yeah, we're more, the information risk is the one, you know, we don't have any control over whether IBM will go bankrupt or not. But the information is the only thing that we look at. The information that we try to, we'll look at their financial statements to see if they're free of material misstatement. Yeah, I don't know, put these last two inches, I don't know. The joke. Okay. Corporate governance. You guys probably already know this stuff. I'll go over it, but the board of directors, they oversee the management of the company. They generally don't do the daily operations. But you know, their job is to oversee the management, oversee the management of the company, their decisions, their operating styles, all that kind of stuff. That's under the board of directors. Audit committee, much less known, and that is made up of a subset of the board of directors. Oh, that's probably one word. It is one word. Okay. Okay. So this is a subcommittee of the board of directors. So it's kind of like this here. I mean, so by the way, sometimes you hear my dog. My dog looks exactly like that. Doesn't have mark on it. All right, so it's sort of like this. So here's the board of directors. And here are all the now, not all of these will be on the audit committee. You know, so here's the board of directors, and then also, you know, here we'll have the audit committee. And the audit committee is generally independent. They're what they call independent directors. Because some of these directors may work in the company. You know, for instance, the president might be on the board of directors, or the CFO or whatever, the CEO, you know, will be on the board of directors, but they'll also be working, you know, in the company. Look how terrible my writing is. I should make a handout for this. So, so anyway, it's kind of a subset of the board of directors. Will be the audit committee, and they will be the ones that oversee all of the interactions with the auditors. Any question on that? So this is one of the important kind of groups that we have here. This is the audit committee is a group of outside auditors. They're independent from the business, and that they are the ones that deal with the audit. So if you have a problem with the management and you're an auditor, this is who you go to. Okay, types of audits. And 3 flavors, 4 flavors. Actually more like 3 flavors. All right. We have financial audits. Oopsie daisy. Financial audits. And this is what we're talking about here. This is for audits of financial statements. CPA firms usually do these. Let's call that so financial audits. Now what we've been talking about. The second one is I'm not sure which one in the book is the second one, but I'll operational audits. And these are made for future improvements. So future improvements in operations, this is kind of what the focus of these are. It's sort of like consulting. You try to make things better. And this is either try to make things usually more effective or more efficient. I think. All right, so these are 2 kind of key words for operational audits. So operational audits are, oh, that's not me. So operational audits, you're trying to make things better. It's sort of like consulting, and it's future oriented. You'll notice that the financial audit is sort of historical, right? It's what happened in the past. What happened in 2020 or 2021? What happened in the past? It's historical. Operational audits are trying to improve. They're saying, okay, this is the state of things. We can improve it by doing X, Y, and Z. We made it either more effective or efficient or whatever. So operational audits have a different focus in that they are actually trying to improve things. It's kind of like consulting. A consulting job is for more or less an operational audit. You come in, take a look at it, try to improve it. Whereas a financial audit, again, is mostly historical. How many sales did they make last year, right? How much inventory they have at the end of last year, that sort of thing. Okay, question on that? Third one. Compliance audits. And these are Comply with a set of criteria. Probably best thing I give an example of this. IRS audit. So, a compliance audit would be something like an IRS audit. Would be a compliance audit. One type of audit, one type of compliance that the school always has is if you're given a grant to do something. For instance, let's say we get a grant from the government to update our IT stuff for students. So, to make improvements for students to access the information systems and IT stuff. They may send out somebody who's an auditor to come out and say, let's see how you spent this money. You're supposed to spend this $30,000 on IT or whatever the amount is. How did you spend it? Did you spend it on what you're supposed to, or did you go buy a motorcycle or something? So you could be complying with, say, a grant or something like that also. But IRS is probably the one that's most familiar to people. All right. The fourth one is actually, it's not really an audit. Integrated audit. Two or more. So an integrated audit is two or more audits complete at the same time. It's a little bit kind of funny because it could be any two types of audits. You could combine any two of these audits or whatever. It could be two completely different types of audits. But anytime you do two audits at the same time, it's integrated. And again, it could very well be that it's more efficient to do it that way. I was an internal auditor for US Steel and for Navistar. And when we go to, say, an assembly plant somewhere, we would say, okay, we want to make sure the financial statements that they're putting out, their financial numbers are what they should be. So we look at that. Then we'd also go into an operational audit. We say, okay, let's look at the operations and see how we can improve it. So we would do a financial audit and an operational audit, do it at the same time. Why? Because we're there and we have all the information. So, that's an integrated audit. But it's a little strange to say that it's actually a separate type of audit, because usually it's two of the other ones kind of combined. Or it could also be kind of the same audit. It could be an operational audit of the sales department, an operational audit of inventory control done at the same time. Okay. So which audit do you use? Happy Bakery wants to improve production. Which of the following audits would be appropriate for this task?
Operational.
Yep. City of Chicago needs assurance that grant money for homeless residents is being spent properly. Which of the following audits would be appropriate for this?
Compliance.
Yep. Yeah, are they complying for what the criteria is for the grant? Types of audit. I think I'll skip types of auditors. I'm gonna skip that. Yeah, and I was right to skip it. We'll talk as we go on in the class. We'll talk a little bit about the different types of auditors, but there's IRS auditors, there's CPAs, there's internal auditors, but we'll skip that for now. Okay, let's go on to the big one here. The AICPA, American Institute of Certified Public Accountants. The AICPA is a club of CPAs.
Billy, can I call you back? I'm in class right now.
All right. So the ACPA is a club of CPAs. So when you pass the CPA exam, they will send you an invite. Hey, we got this club of CPAs and we hear you're in it. So do you want to join our club? And you can say yes or no. And once you become a licensed CPA, if you want to join the club, you can. And again, it's a club. It's just a group. And so you kind of think to yourself, well, okay, well, why would I want to do that? And what is this group anyways? It's a club similar to like the Boy Scouts or something like that, but it's made up of CPAs. Okay, now they make a few different things. One of the things they make is auditing standards. And you might say, well, who cares? Okay, there's this club and they make auditing standards. They also make accounting standards too, but auditing standards. You say, well, who cares? It's a club. It's just like the Boy Scouts making, does that have any impact on anybody? Well, a lot of times these AICPA auditing standards become state laws. So the state of Illinois will look at these standards and go, hey, that's a good standard. We're going to make that into a law. So this club, even though they have no government authority or anything else, it's just a club, they make these standards, a lot of times those standards become law. Also, for federal to audit on publicly traded companies, they're required to be members of the AICPA or some similar organization. It's a foreign group. So you must have a membership in them, and so you must follow their standards because they are, if you want to be in their club, you have to follow their standards or they'll kick you out of the club. If they kick you out of the club, you can't do audits for publicly traded companies. So while it seems like, gee, this is just a club that doesn't really have any power, they actually are quite influential. They also make, oh wait, I missed an A here. And by the way, you finally see this American Institute of Certified Public Accountants. They just call it the AICPA. This is the usual way. So the AICPA creates a CPA exam. Every state in the US hey. So the AICPA creates a CPA exam. And every single state in the United States uses this exam to license CPA. So if you're sitting for the CPA exam, it is the exam made by the AICPA. Now, the state of Illinois could wake up tomorrow and say, we're not going to use your exam, we're going to make our own exam. They never have, and they probably never will. But so this AICPA, they are the ones that make the exams to get people, allow people to take the exam and to become licensed certified public accountants. And every single state uses it. So you know, if you think about that, that's a very powerful thing that they actually make the exam, the, you know, the watermark for getting your CPA license. So, and every single state uses it. So that is also a, you know, part of the ACCPA, that they're a very powerful group. And, you know, again, states don't have to use it. They could use something else, but no, every single state does use it. Okay, by the way, you guys have probably most of the time. I think we'll stick on this chapter 1 and 2 stuff. We'll plow through a little bit of it. We'll do a little bit of the sampling stuff next week. So we'll continue with this, and yeah, for today. Okay, state boards of accountancy. They issue CPA. Oops. CPA licenses. So state board of accountancy, they'll issue CPA licenses. So Illinois, they have a board of accountancy, they will issue CPA licenses, just like, and the states issue the CPA license just like they issue car license. You know, an Illinois driver's license, it's the same thing. It's the state's licensing you to drive a car. State can be licensing you to be a CPA. Okay, so it's the same idea though. And notice that that's all controlled by the state. It's not controlled by the federal government. It's not controlled by the AICPA. You know, the AICPA, do they issue licenses? No. It's a club. The state issue licenses. You know, the AICPA is just a club. They don't issue CPA licenses. They don't issue driver licenses or anything else. It's just a club. They make the CPA exam, but the states are actually the ones that actually will issue the licenses. Okay, and by the way, they're also the only ones that can, you know, have any control over the license in the state. Okay, Securities and Exchange Commission. Issuers. These are publicly traded corporations. Issuers is a key term. It's the term that the AICPA uses all the time. And for publicly traded corporations. Non-issuers, I think this is one word, by the way. Non-issuers. These are privately held businesses. And by the way, that issuers and non-issuers thing, they really hit that on the CPA exam. Issuers are publicly held companies. You know, you buy a stock. IBM is an issuer. They issue financial statements to the public. Non-issuers aren't required to issue financial statements to the public. So, you know, Joe's hot dog stand, they don't have to issue financial statements to the public. It's a non-issuer. Non-issuers can be big. There are some large non-issuers, but you know, for the most part, the larger companies are going to be issuers. IBM, Microsoft, Google, Apple, all, you know, whatever. Those are all issuers. They all issue financial statements to the public. Non-issuers don't. Now, why does that matter? It matters because of this. The Securities and Exchange Commission, often called the SEC. Oops. The Securities and Exchange Commission only regulates issuers. Ooh, hold on a second. So, Securities and Exchange Commission, probably the most powerful government regulation of business in the United States. They are only for issuers. So IBM, they have to deal with the Securities and Exchange Commission, and whatever the Securities and Exchange Commission says goes. Joe's hot dog stand can completely ignore the SEC. SEC has no jurisdiction over non-issuers, over people that do not issue financial statements to the public. They have no control over them. They can't tell them what to do. They can't regulate anything they do. It's simply not part of what they can regulate. So they can only, SEC can only regulate issuers. Okay, Public Company Accounting Oversight Board. All right, this came about through Sarbanes-Oxley. First of all, this is, they are part of the SEC. Oops. So Public Company Accounting Oversight Board. This was created by Sarbanes-Oxley Act, which I should probably talk about. And they're also there to, they can also, they only regulate issuers. All right. So the Sarbanes-Oxley Act is a very strange. It was a very strange thing that happened. This was years ago, like 20 years ago. I don't know if you guys talked about this in other classes or not. The Enron case. Enron was an energy company. A really seen as really a very progressive and very cutting edge energy company, and they're going to rule the world kind of a company. Well, they were caught up in a fraud that was for $1 billion fraud. Now, to put it in perspective, big frauds before Enron were 20 million, 30 million, 50 million. Those are big frauds. No one ever imagined that you could have a fraud of $1 billion. It just didn't seem like it was possible, but here it was. The company that the audit firm that was doing their audits was called Arthur Andersen. Arthur Andersen was the largest CPA firm in the United States. Everyone wanted Arthur Andersen's name on their audit reports. It had a real a real name for themselves, and that people wanted to have their name on the reports. Biggest CPA firm in the United States, possibly one of the biggest in the world, if not the biggest in the world. And the Enron case sunk them. Everyone wanted to have Arthur Andersen's name on their audit reports until Enron. They missed $1 billion fraud. Then their name was like poison. Remember the credibility thing? They had no credibility. In fact, people, if you had Arthur Andersen's name on your report, people assumed that you were fraudulent because you have Arthur Andersen's name on your report, and that was associated with it. So anyway, Arthur Anderson, it sunk Arthur Anderson. No one wanted it, and the firm broke up. All right. Everything started to settle down about that for what, okay, Arthur Anderson's out of business now. There were bad people and blah, blah, blah. A year later, WorldCom hit. WorldCom was a fraud that was $2 billion. When that second fraud hit, the entire market started to suffer. The entire stock exchange started to suffer. No one believed anything. It didn't matter who did the audit. Everyone just thought that, hey, these large companies, they're putting out these fraudulent financial statements. Everybody's, putting these out. So it was a real panic in the market. The Sarbanes-Oxley Act had been an act that was trying to be pushed through for years through Congress and was always getting killed by business. Business said, no way, you can't do the Sarbanes-Oxley Act. We don't want it, and it would get killed. It wouldn't even be close. So anyway, this thing, bounced around Congress for years. Okay, all of a sudden, no one trusts anything they're doing, and these companies are looking at this saying, oh my gosh, we got to do something because no one believes us. Congress, can you do something? They said, well, with the other Sarbanes-Oxley Act. So the Sarbanes-Oxley Act came out. It was already around for years and being not passed. And then it came in, but then businesses begged for it because no one believed the financial statement. So that's how the Sarbanes-Oxley Act came around. One of the things that they ended up making with the Sarbanes-Oxley Act was this group, the Public Company Accounting Oversight Board, PCAOB. It just rolls right off your tongue. I wish they could make a better name, a better acronym for it, but that's what it is. So anyway, this come out, and this group really regulates auditors and the companies and their dealings with auditors. So this is specifically to address these problems with auditors and their clients, their publicly traded clients. So kind of a strange thing, a strange arrangement that came about because of a couple fraud. Okay. Let's go to number 5. Which organizations can license certified public accountants? Hey, you guys are sleeping, aren't you?
States.
States. And which group can revoke them?
States.
Yep. States are the only ones that issue the license, or the only ones that can revoke them. None of these other groups can do anything about it. Okay. And we'll go a little bit into the firms, and then I think we'll call it a day after. All right, so let's go through the types of CPA firms. A CPA firm could have one person in it. If you're a CPA, you could have your own firm. Nothing wrong with that. There's a lot of them. They're just single people, single CPAs. They have their own firm. They want, and if you want to own your own business, it's the way to go. You don't have someone telling you what to do. But then they also have larger firms with more CPAs, and they get bigger and bigger and bigger. And the CPA firms themselves generally get more complex. So small firms are usually fairly simple, or usually are. And as they get bigger and bigger and bigger, they get more and more complex, and they take clients that are more and more complex. And if you think about it, okay, who can do an audit? Well, anyone who's licensed is licensed to do an audit. But is that really the case? Could somebody working by themselves do an audit of IBM, Ford Motor Company, or whatever? Well, no. And some of these companies are so large that they have places, they're spread out all over the world. You have to have CPA firms that are spread out all over the world to do these audits, right? So, CPA firms don't come in the same sizes, and generally speaking, their clients match up with the size of the firm. Smaller businesses, use smaller CPA firms. As things get bigger and get more complex, they go to bigger firms. For instance, if you had, operations in several states, you'd want to have a CPA firm that has offices in several states. It may not be worldwide, but let's say you have businesses in Illinois, Wisconsin, and Indiana. You're probably going to want a bigger firm, a firm that actually has auditors in, those states. So generally speaking, the size of the business kind of corresponds to the size of the CPA firm. And there's no real connotation to that. I mean, you can be very successful and be a one-person show, and that there's nothing wrong with that at all. It's just that for the bigger clients are going to need people all over the world. So these kind of go along with that idea. So local firms usually are in one location or one state. Oops. And they probably have somewhere between, say, 1 to 15 partners. Regional firms, more than one state. And they may have anywhere from, say, I don't know, 10 to maybe 100 partners. National firms. They're in all states. And they could have hundreds of partners. The international firms, these are the big four firms. These are in all states and in most countries. And they could have hundreds or thousands of partners. Oops. So the big four firms, when you're looking for jobs in accounting in general, auditing too, but in accounting in general, one of the things that is highly prized is big four experience. That's not to say that working for any CPA firm would be a really good idea, but they didn't have a little bit more name recognition, the big four. So one of the things that in accounting they'll talk about is having big four experience. Quite honestly, people who know about this, it probably doesn't matter that much. But anyway, so the big four those are kind of the most prized first jobs in working with for in accounting in general, but also for working at CPA firms. So, one of the things is by getting those jobs, if you seriously are looking for those jobs, you generally go through an internship with them. And that internship is generally what grows into a job. And they don't change too much from that approach. They might a little bit, but a lot of their they don't change too much from you come on as an intern maybe a year before you graduate, and then you graduate and they offer you a job. That's usually the way it kind of works. So not that they wouldn't hire you if you didn't have an internship with them, but that's usually the way it does. And I just tell you that because it's one of those things that a lot of times it's a good idea to kind of plan ahead. If you're thinking about going into a CPA firm, especially the larger ones, they generally are set up that way. And that's where probably 90 whatever % of their people come in that way. But anyway, so the larger firms, for whatever reason, are the ones that are more sought after. And part of the reason is because if they do more complex audits. Okay, so let's take a look here. Which the following types of CPA firms would be appropriate to perform an audit of a bakery that has operations in Illinois and Indiana?
Regional.
Probably regional. Yep. And by the way, you know, I'll say, to say something else about this really quickly, and that is that a lot of times, and I'm not telling you not to go to the smaller firms, though. A lot of times the smaller firms, you'll see a lot larger area. You do a lot more things just because, you know, you are a smaller firm, you'll do things with marketing departments, you do, you know, all these other departments that, whereas if you're in a larger firm, they might have you kind of stuck in one field. You know, if they're doing audits of, say, manufacturing companies, that's kind of what you're going to learn is manufacturing companies. If that's what that partner has, you know, that if that's what they're doing is, whereas the smaller firms, you might do manufacturing company, you might do consulting businesses, you might do all kinds of stuff that, you know, all kinds of different types of businesses. So you might actually get a larger view of things than in CPA, the larger CPA firms. Okay, now we'll talk about this now. We'll call it a day after this one. Okay, CPA firms, the CPA exam rules break them up into the 4 groups that I'm just going to show. I'm going to show you in a second in the handout. If your CPA firm is not set up that way, the CPA rules are such that they say, okay, well, you have to find an equivalent to it. So for instance, they have a designation of a position called managers. And you may have a CPA firm that says, well, we don't have managers. Okay, well, find somebody who meets the definition of being a manager. Then that's them, you know. So they kind of tell the CPA firms, you can organize however you want, but everybody has to fall in these 4 categories. Okay, so a staff assistant. This is the first oops, that's nice one first. First job in public accounting, this is where they're going to bring you in. So your first job in public accounting is going to be a staff assistant. This does not require the CPA license. So you do not have to be a CPA to get this first your foot in the door. And most people that come in are not CPAs. Now, to move to the next level, to move to the senior level, you have to pass the CPA exam. So what they do is they generally, when you come in, they will give you the a CPA review course. You know, one of the standard CPA review courses. They'll say, here's the CPA review course, you have access to it. If you want to move up to the senior level, you got to pass the CPA exam because all seniors must be CPAs. So when you come into the audit, into the CPA firm, you do not need to be a CPA or have passed the CPA exam. If you have, great, but you do not have to have that. But to move up, you do. Okay, senior level. This is what you supervise an audit. You supervise an audit. You must be a CPA. This is the level the CPA exam is usually aimed at. So the CPA exam is really aimed at this level of the organization. You know, kind of like this is, this is your first, kind of getting your driver's license, this is your first time out driving. And so this is what we're aiming our exam at, is to make sure that you're okay doing what you need to do to supervise an audit. So moving up to the senior position is requires you to be a CPA. You're going to run an audit yourself. So if it's an IBM audit, you might be running an IBM audit. And by the way, it's not unusual to have these people be fairly young doing it. It's not unusual to have a 25-year-old running an audit of IBM or something. That's not unusual at all. I know it sounds strange, but you have people that they go through a couple of years and they hit that senior level and they start supervising the audit, and you can have very young people supervising very big audits, and that's kind of one of the reasons why this experience is sought after, is that there's people that can handle big things like that. So okay. Managers, they will supervise seniors. Oops. And they may have, say 2 to 6 seniors. Oops. And they may have several audits going on at the same time. So a manager will supervise seniors, 2 to 6, maybe is probably a common size group. And they'll be overseeing many audits at the same time. The seniors have problems, have questions, have problems with the client, have, whatever it is. They go to the manager kind of oversees all of that and keeps all these audits going on at the same time, trying to make sure they get done on time, get done, whatever. You have to shuffle people around between audits, that sort of thing. So the managers are there to kind of coordinate all these audits that need to get done and supervise the seniors that are doing it. And partners, what's their job? Partner's job is the same as any partner's job. Partners must bring in clients to the CPA firms. That's their job. So partners bring in clients, and by the way, that's the same for all partnerships. How do you make a partnership in a law office? By bringing in clients. If you can bring in clients, that's how you make partner. If you can't bring in clients, you're not going to make partner, and that's just the way it is. And the partner's whole job is almost like a high-level sales job. Their whole purpose is to bring in clients, to the CPA firm. That's basically their job. So that's what partners do. Now, you'll notice something about this that seems a little bit sinister. Staff assistant 1 to 2 years, 2 to 5 years. So the question becomes, okay, well, what if you work for 2 years here and you don't make senior? They let you go. But if you're a senior and you work for 5 years, whatever, and you don't make manager, they let you go. Same with managers. You can't have managers sticking around either. And you may wonder, why is that? You know, why don't you, if you find somebody who's a good, let's say you just a good assistant, you know, a good associate, you know, and they've been around for more than 2 years, well, why don't you just keep them? They you know, do good work, they show up, they're fast, they're efficient, that way, why don't you do that? You can't do that because you need to have partners to survive. Any partnership, but CPA firms too. You have to have partners to survive. You cannot, you know, if you let people who are competent fill up those lower levels, you're not going to have people that can get promoted up to senior, to manager, and then to partner. At some point, it's going to be all plugged up with people who are not going to be moved up. So for that reason, CPA firm, as well as other partnerships, you know, especially like things like law firms and that, if they can't be promoted up, it's up or out. Now, you say, well, that's terrible. That sounds awful. Well, not really. Most people don't make partner. 1 in 100 people going into CPA firms make partner. But if you're moved out, a lot of times you're moved out to a client. So maybe you're doing the IBM audit and you're not going to get moved up. And the CPA firm will say to IBM, hey, you know, we got this person we usually can't move up. Do you have any openings? And they'll say, sure, we love it. Remember, the CPA firm holds that, you know, that designation, you know, that work experience of working in a CPA firm carries a lot of weight. A lot of times the clients will take people on from, you know, the CPA firm and move them up to fairly high levels, usually right away. They might be in a level coming out with 2 or 3 years experience in a CPA firm. They may walk into a job that is normally 10 years of experience for most people. So they actually kind of move up right away. And usually the job is better than working at a CPA firm. CPA firms really work you to death. And that's all the way up to partner. But so even though it might sound very callous and cold, but actually usually the people that do, you know, step out are the ones that, you know, they usually do fairly well doing that. So while it does seem like it's a little bit cold, it actually is, there's a reason for it. And a lot of times they will find me a position for you. Okay, we'll stop here, I guess. Okay, so today, a couple minutes left. So here's what you're going to do for today, and this is you're going to go to the submit thing and submit that beginning of the semester quiz. We're not going to submit the handout, chapter 1 and 2 handout, because we're not done with it. But you can submit that little, no, not that. No, not that. What did I do? I closed it? I must have closed it. All right. That first thing that second thing we did, where is it? This thing. So submit this thing in and it'll count as a grade. So it's beginning of the semester information quiz, submit that thing. And that'll be it. We'll go ahead and get more of the stuff the following week, but see if you can get that in. Now, just so you know, this video will be recorded. It'll be up. I can usually get them in by midnight. It takes about an hour after I close this for. I don't know. I need to tell you all this baloney, but anyway, the Zoom meeting takes about an hour to render. Then I have to edit it. It takes about another hour or 2 hours, but probably closer to 2 hours. And then I submit it into YouTube, and YouTube takes about an hour. Sometimes it goes really fast. Sometimes 15 minutes. Sometimes it's 5 hours. But this will certainly be up by tomorrow, and hopefully by midnight. I usually get them in by midnight or 1 p.m. So if you need to go back and look over something, you missed something or whatever, or you weren't able to make it to class, it usually gets put up. I think I say within 24 hours, but usually it's shorter than that. Usually I can get it in by, say, midnight of the night that we do it. All right, any questions? Any of that? Okay, so we'll start up on the chapter 2 part of it next class. And I think we'll go right into chapter 3, because it seems like a number of you, this is gonna be your first auditing class, and there's some stuff that we should probably go over. The chapter 3 stuff we'll go over. It's the ethics part. That's about 20% of the CPA exam. So it's if you're in an auditing class, it's a good one to hit. A good bang for the buck, right? I mean, it's basically one chapter, and it covers, a significant part of the CPA exam. All right, any questions on this? Okay, well, so then just turn that one, the first handout we just did, the beginning of the semester information stuff. Turn that in, and next class we'll pick up chapter 2 and start in chapter 3, and probably do some of this, probably do some stats next week too, just to kind of break it up a little bit. As you can kind of tell, this is kind of definition-y, so it's gonna be a little dry for the first couple chapters here anyways, but it'll pick up a little bit later on. Okay, any questions? All right, I will see you guys in a week's time, and have a good weekend.
Thank you, Professor.
Good
Thank
night.
you.
Good night, guys.
Thank you.